So slippage refers to when a stop or a market order is executed at a different price level than you had actually initially set in your order. So what this means is that you can be entered into a position or maybe stopped out of a position at a worse price level than you had actually anticipated, but it can also work in your favor too. Say if you set a take profit order and then you can be slipped and stopped out of your position at a higher or better price level, I should say, than you had intended to for slightly more profit. Now, slippage is almost always due to low available liquidity. Now, market liquidity is just essentially the amount of demand and supply that is in a market at any point in time. So it's the ease to which a market can be traded without really affecting its price. So this diagram here, it basically illustrates what liquidity looks like in terms of an order book in the market. So all of these lines, each of these lines that you see here, each line represents a price level in the market. So if a market is extremely liquid, there's going to be bids and offers at pretty much every single price level, but also with a large amount of volume on each of those price levels, right? So it's going to take a lot of money to move through that, to make price move up and down through those orders. However, if it's a liquid, then there may not be any bids or offers at certain price levels, and or the quantity of supply and demand at those price levels might be a lot lower too. Right, so this is where, if someone was to put through a reasonably big order, right, it's going to eat up all of those bids or offers, right, and smash through those orders pretty quickly. And this type of market condition is where you will often see price sort of gapping up or down to fill the next best available order, and price can be quite erratic when it's like that. Because remember, for every buy order in the market to actually be filled, it must be matched with an equivalent sell order. And vice versa, for every sell order in the market to be filled, it must be matched with an equivalent buy order for that trade to actually occur and go through. So, for example, let's say price comes to the level at which you set your stop loss order at, where you want to be closed out of your position. If there are no other orders at that level for you to trade with, right, to get out of your position, then price is just going to keep moving until you are filled at wherever that next available level of liquidity might be, which means that you're likely to be closed out of your position at a worse price than you had initially intended, which means that you're going to essentially book a larger loss than you had anticipated due to being slipped and filled at a worse level. But like I said at the start, this can also work in your favor, however, with your take profit orders, where you can benefit from positive slippage by your broker, essentially closing you out of the trade at a better price level than you had intended to close your trade at. Now, generally, slippage can be anywhere from a micro pip to tens of pips, and in some rare circumstances, sometimes even hundreds or potentially even thousands of pips. Now, it will vary between brokers and will ultimately depend on the depth of their available liquidity at the time. Now, probably the main thing I want you to take away from this lesson is that the smaller your stop loss size is, then the more you need to be aware of those news announcements and periods where there is likely to be that low liquidity. And we're going to take a look at a couple of trade examples just to kind of really drive this point home, where we're going to look at what happens if you have a 3 pip negative slippage. So on this first trade example, where your stop loss size is only 3 pips, that means that you will actually be stopped out for a minus 6 pip loss in total, when of course you include the 3 pip slippage, right? So a 6 pip loss is double what you had initially intended to risk, right? Because you only intended to obviously risk 3 pips. Now you've lost 6, so that's 100% of your initial risk. So in this case, on this trade, if you had intended to risk 1% of your total account balance on the trade, you would actually end up taking a minus 2% hit instead. Now in the second example, where you have a 30 pip stop loss, 3 pip slippage is a lot less costly because that only represents 10% of your initial pip risk. So if you risk 1% of your account balance on this trade, you would then only take a 1.1% hit to your account size, even though both trade stop losses were slipped by the same amount, right? Both trades were slipped by 3 pips, but you can see, in each case, there's quite a big difference in terms of the actual loss that you book onto your account. So, really bear this in mind if you are a trader who trades with relatively, small stop loss sizes, because slippage is going to be something, even more so than potentially other traders that you really, really need to pay, special and close attention to. So, how can we try to anticipate where there will be low liquidity so that we can potentially avoid trading around these times in order to reduce our risk of potentially experiencing, negative slippage? Well, liquidity really depends on many factors, but some of the main ones are session timing. So we'll talk about this in a bit more depth later in the program, but essentially the London session and when New York opens, whilst London is still open, so we have the London and New York crossover, those are the most liquid periods of the trading day typically, as this is when the majority of the world's trading volume is executed in the Forex market. So therefore the Asian session, it typically has much lower liquidity and most traders choose not to trade during this time. However, if the Asian session is the only time period in which you can be active on the charts, depending on your job and your lifestyle, it is still more than possible to trade it profitably. But this is where you may potentially want to concentrate on currencies that are part of the Asian time zone. So currencies such as the Japanese yen, the Australian dollar, and the New Zealand dollar, for example, if you wish to trade during the Asian session, just because these are going to, likely have slightly higher liquidity than the European and North American currencies during that Asian window. Now, the other big factor to consider is the daily rollover, and this occurs at 10 p.m. GMT every weekday when the market rolls over to the next trading day. So for about an hour to 2 hours, what you'll see is that the majority of the orders are actually pulled from the market. Generally, it's because those people and those market makers, they do not wish to pay the rollover swap fees, which we're going to talk about in a lot more detail in the trading cost lesson in the module on brokers. So don't worry too much about that just now. But yeah, the other sort of low liquidity period will obviously be on weekends, of course, when a lot of market participants will close out of trades, any trades that they're in, and they'll usually pull and cancel many resting orders that they may have before the market closes for the weekend, so that they remove their exposure, to any potential event risk that can happen over the weekend, so that they do not experience any potential heavy slippage. Sometimes if the market were to gap over the weekend when the market then reopens. It's pretty rare that it can do that, but this can obviously happen when there are big events such as elections, for example, or potentially anything unplanned could happen over the weekend. There's a natural disaster or something. Now, another main factor for when there can be low liquidity in the market is around news events. For pretty much the reasons we've just discussed, market participants are going to pull their resting orders from the market until the news event has occurred, so that they remove their exposure to a potentially large market moving event. Now, most of these are planned events, which you can track in an economic news calendar, such as economic data releases, speeches by economists and politicians, as well as government elections. But like I was saying, there are also unplanned events that can hit the market without warning, such as natural disasters or just anything that can cause large economic shocks. So I'll show you where you can view these planned announcements in a second, but the main ones to keep an eye out for in terms of low liquidity and what tend to move the market the most are the central bank announcements. So this is where interest rate decisions are released, and these can often, but not always, have a pretty large impact on their initial announcement. Now, FOMC is probably the main one that you're going to want to be keeping an eye out on, and that's from the US central bank, which usually will see a pretty large amount of intraday volatility. Now, the other main planned high impact news events are government elections, the inflation figures, so you'll often see these denoted as CPI, or the main ones are the CPI, and then your employment figures as well. So again, in brackets there we have NFP, which stands for non-farm payroll, and that is the American employment figures that are usually released on the first Friday of every month. And this also typically sees quite a large amount of intraday volatility. So yeah, do keep an eye on that. FOMC, the CPIs, and the NFP is probably one of the biggest sort of intraday movers as things stand with the current market conditions. Okay, so there are a few sort of economic news calendar websites that are really good that you can use, and I'll put a link to a few of them below in the notes below the video. The Forex Factory is probably the most common one. It's the one that I typically tend to use. It's just pretty useful and keeps things pretty easy. So this may be how it looks the first time you ever jump on it, and it essentially shows the daily view, and it just shows all of the news announcements for sort of the major currencies of the day. So what it will just show you is obviously the date, the time of the news, the currency that it's most likely to impact, and then here you kind of have this color coding system. So yellow for being sort of what's expected to be low impact, right? Obviously you never really know. It's not as simple as just yellow, orange, and red, that's going to have a certain amount of impact on the currency. It's going to depend on so many different fundamental factors. But this is a pretty good, accurate guide, kind of rough guide of generally how big these kind of events tend to be. So yellow being the least, obviously orange being the medium, and then red being kind of those real high impact, bigger movements. So that's kind of a bit more of a simple color code there for what you can expect in terms of sort of intraday volatility. And then obviously you have the description of what the news release is. And if you want a bit more detail, you can just click into here, and then you can literally go in, you can read all about it. It's kind of more what you'd be doing if you're kind of really that macro trader. And you can look at all the previous data releases for that specific news event. The actual results, the forecasted result, previous results. It's got useful graphs and all of that jazz. And then what we show you for the day is it will show you obviously the actual result when it comes out. This hasn't come out yet, so it's not going to give us that result, but it does show you what the forecast would be, and again the previous results. You can quickly pop out that graph there if you so wish to do so. So the first thing I would actually do before you even do any of this is make sure that you have the right time synced up to your time zone. So if you click up the time on the top left hand side, get rid of these annoying ads. Now you can see that it's synced up to my time, and you can just play around with that for whatever you want, and then click save settings. Now, one thing I will say is, although it saves settings now, what I often find is sometimes, I don't know if it's something to do with the cookies in the browser, I'm not that computer science sort of technically aware of all that stuff, but for whatever reason sometimes it's resets. So just keep an eye on it, especially with daylight saving times as well, just to make sure that you do have these. It's just important, right? You don't want to be missing out on that news by an hour or two and not being aware of it for reasons which we'll get into when we talk a little bit more about slippage and whatnot. But yeah, so once you've got your time zone set up, the kind of another way you can view it is for the week, which is also pretty good. So on the weekend, on Sunday, when I'm doing my watches for the week ahead, I will have a quick scan to see kind of what are the big market moving potential events of the week ahead that affects the currency pair or pairs that I'm looking at to trade. Now, one thing you can do is you can actually use this filter, and you may want to get rid of sort of the low impact news events, or potentially even the medium as well, but I prefer to keep that on. I'll typically just get rid of the low impact ones, and then the grey one here, that is just for bank holidays, so that can also be useful, just because if there's a US bank holiday, then typically there's a lot lower volume in the markets, for instance, like that. And then you can apply that filter. You can also just do the currencies that you trade as well. So if you know that you're not going to trade any Chinese currencies or whatnot, you could get rid of that. But then you also have to be aware that sometimes, Chinese economic news can have an impact. For instance, if you're trading the Australian dollar currency, Chinese economic releases can have quite a bit of an impact at times on that currency, as obviously they're quite heavily connected as trade partners, right? So it's better, I believe, just to keep that off. If you are really going to filter anything, probably just take off low impact and potentially medium as well if you wish to do so. But yeah, personally, I'd rather just kind of keep an eye out on all of them. So yeah, that kind of pretty much wraps it up. Just make sure you have this saved as a favorite or bookmarked on your toolbar, and just you need to be looking at this at minimum every weekend. But if you are day trading, especially if you're looking for those intraday entries with quite tight stops, then you need to be very, very aware of when those news releases are going to happen. So for instance, today, let's say we're on Thursday and we have US PPI right at 1:30 p.m. Essentially, it's a measure of inflation, the change in price of finished goods and services. We don't need to get too caught up on that. All we know is USD right at the New York Open around 1:30. It's going to be high impact news. Very likely we're going to see some widening spreads and some intraday volatility there. So I want to be aware of that I'm not entering a position right at that time. So what I would then do is I would then hop on the charts, right? So say we're looking at euro dollar, and I would go to where 1:30 is on my chart. So if you just move the mouse to there, right, 1:30, and then what I would do is if you go up here where they have sort of trend lines on these line tools, and then if you go down to vertical line, and then you just save that to your favorites toolbar, and then if you click that and then sync it up with where 1:30 is, so boom, right, and then you've got a line there, and then maybe you want to make it a bit thicker just so you don't miss it, and then maybe make it red, or so on and so forth. You can make it dotted or whatever, right? And then right, you're not going to forget. Boom, high impact news event around that time. You may want to do a little window of 5-10 minutes, whatever your personal trade plan states of where you don't want to trade around that news event. You just want to be aware of it, and then that way you're not going to forget. And suddenly, if you start seeing large, big spikes like this, you go, okay, boom, I had news there. I believe this was caused by US CPI. Yeah, bang, 130 yesterday, there was CPI. Let's have a quick look on the calendar. Yesterday, 130, yeah, so that was that movement there, right? This CPI here yesterday was what caused this. So this is why I would have this on my chart, just so I'm ready and waiting and knowing that we're likely going to see a decent intraday movement there. So definitely something I would recommend, and definitely something you need to do, you need to be aware of. Now another thing you can use that TradingView have introduced, it's not something I really personally use or have played around with much, so yeah, I can't really vouch for it, but if you open up the settings of the chart and then you go down to events here, then you can click on show economic events on the chart, and then if you click that and click OK, it does have these pop-ups down here that should be related to the currency pair that you're obviously viewing at, so you can automatically see that. So down here, I don't know if, yeah, so if you can click on it and then you get all of this kind of pop up. So yeah, you might find that useful, you might not. I believe as well, do they have it on the right hand side here? Yeah, so they've got some more information here as well if you click on the calendar there. So yeah, play around with what makes most sense to you. Personally, at the moment, I just prefer to use the Forex factory calendar. I think investing.com have a brilliant one as well. I'll just find the ones that are quite common, are good, and I'll put them in the notes below. Yeah, and just make sure you do this every single trading day. It should become a part of your trading routine. If you're a day trader, you need to especially be doing this every morning. If you're more of a swing trader, then maybe just once a week is enough for you. But yeah, definitely have these on here. And then you want to just, yeah, more than be aware of that, or you can really find yourself in some tricky situations at times. So yeah, that wraps it up on news and slippage. Slippage is something that can be extremely painful when you are trading on such tight margins, with tiny stops. If you're in with 2, 3, 4 pips, then you can very, very easily, especially even during CPI like this, when there's those low levels of liquidity during those kind of events, then yeah, it's pretty easy to take a sizable hit. Now on days when we have NFP and things like FOMC, and we have those big interest rate decisions from the Fed, you can see multiple 100 pips movement that go on for days. But yeah, during those news events, you can really get whipped about, so it's just not worth trading. Don't forget to do this every single day and make sure they're on your charts, and it will save you a potential headache.